On January 8th every year, the market looks the same to me. A lot of very smart people telling stories about what the next 12 months will look like, and a lot of ordinary people confusing calendar noise for genuine opportunity. Right now, you're hearing phrases like January effect, New Year rally, January barometer. The screens are green, commentators are excited, and people are talking about how as January goes, so goes the year. It all makes for good television. It does not make for good investing. The data on the so-called January effect is mixed at best, fading for decades, and heavily dependent on behavior that may or may not repeat. So let me spoil the plot early. The New Year rally is mostly a lie you tell yourself to feel good about buying when everyone else does. If you're going to do something intelligent, do it before January 15th. Not because the market cares about that date, but because you need a deadline to stop reacting to fireworks and start behaving like an owner. Look around in the first trading week of 2026. You've got CNBC and its cousins talking about the January barometer, implying that the first month sets the tone for the year. Hedge funds and institutions still cleaning up their books. Window dressing for clients and marketing decks. Retail investors dumping year-end bonuses into whatever did well last year, promising themselves that this year I'll be disciplined. That isn't insight, that's emotion. Tax quirks, bonus flows, and storytelling. Studies that once showed small cap outperformance in January have either faded or become unreliable as people tried to trade them. You wouldn't build a 30-year plan on whether it rains in Omaha one week in January. You shouldn't build a 30-year capital plan on whether the first 5 trading days happen to be up or down. Here's how I think about it. The weather will change, but the climate is what matters. January price moves are weather. The climate is interest rates, business earnings, and valuations. Right now, as 2026 begins, the conversation that actually matters is where are interest rates likely to be over the next few years. Many outlooks see central banks near the end of their cutting cycles, not eager to push rates back to zero. What will corporate earnings look like when companies start reporting in late January and February? Consensus heading into 2026 expects solid earnings growth, but that's in the price. If reality disappoints, prices adjust. How expensive are stocks relative to their profits and to the size of the economy? Valuation models, including versions of the so-called Buffett indicator, have been hovering in overvalued territory, suggesting lower forward returns from here. None of that cares whether the market is up 3% or down 2% in the first week of January. Weather will get the headlines, climate will get your money. So what should you do before the 15th? You don't need to predict the year. You need to clean house. Take one quiet evening. Log into your brokerage account and go line by line through your holdings. For each position, ask only one question. Did I buy this because of a story I heard around New Year's, or because I truly understand the business and its value? Call these your narrative holdings. The stock you bought because some commentator said January is usually strong for small caps. The ETF you bought because it had I or 2025 winners in the name, and you felt like you were late last year. The company you bought on January 2nd because you made a New Year's resolution to start investing and needed anything to buy. Those are weather trades, not climate investments. Before January 15th, here's the mandate. Make a list of any position where your entire thesis is essentially, it's a new year. This strategy usually works. Everyone seems bullish. If you cannot explain in 2 or 3 sentences how this business makes money and why it is reasonably valued based on earnings or assets, sell it. Take the proceeds and park them in cash or very short-term, safe instruments, your own little January cash bucket. You're not doing this because a crash is coming on the 16th. You're doing it because you refuse to let a calendar flip be the reason you own something. That's not investing. That's seasonal superstition. Once you've cleared out the narrative junk, your job through the rest of January is not to find the next thing to chase. Your job is to prepare your watch list. The real opportunity in a year like 2026 probably won't show up in the cheerful segment they run on January 2nd called New Year, New Highs. It will show up in what I'll call the February fear. Here's the pattern. January is full of optimism, resolutions, and positioning. Then, toward the end of the month and into February, companies begin reporting actual earnings. Guidance gets updated. Reality appears. Markets start reacting to real numbers and policy hints, not just calendar talk. Some beloved names miss expectations. Some sectors show that last year's growth was not sustainable. Volatility rises. The same commentators who were talking about January barometers start running segments with words like jitters and sell off. That's when you'll see what was solid and what was fluff. That's when assets tied to genuine cash-generating businesses may get dragged down temporarily right alongside the garbage, simply because money is moving and emotions are flipping. Your edge in February won't come from knowing the exact date or headline. It will come from having done your January work. You'll be holding more cash because you sold your narrative holdings before the 15th. You'll have a watch list built on climate, not weather companies and funds you understand, with strong balance sheets, durable advantages, and reasonable valuations. While others are panicking about a 10% drop after a 20% run, you'll be calmly comparing prices to the values you estimated at your kitchen table. So how do you build that watch list? You ask different questions than the January crowd. Instead of what's up the most this week, ask, if the market shut down for 3 years, would I be happy owning this business? Is this company likely to earn more money 5 and 10 years from now, regardless of the calendar? At today's price, am I being paid fairly for the risks, interest rates, competition, economic slowdown that could show up? Look for strong free cash flow and reasonable debt levels. Moats, brands, network effects, cost advantages that don't depend on a bull market to survive. Valuations that make sense, even if growth slows a bit from the rosy forecast being thrown around in early year outlooks. Write these down. Name the price where you'd be delighted to buy, then wait. If February or March or June gives you that price often on a day when everyone on television sounds scared, you don't have to scramble, you just have to execute the plan you wrote when you were calm. That's the real anti-January strategy. Use the first 2 weeks not to join the parade, but to step to the side. Sweep out anything you bought for the wrong reasons. Build cash, build clarity. The market is going to do whatever it wants in the short term. I never know what it will do next month. What I do know is that you can decide not to be the person who buys because it's January and sells because it's February. You can be the person who buys when value and price line up, whatever the month is called. So here's your simple checklist, delivered like a slightly amused grandfather watching the neighborhood kids set off fireworks before January 15th. Open your portfolio. Identify every holding bought on a New Year whim, headline, or vague seasonal rule. If you can't explain the business and the valuation, sell it. Move the money to cash or TD bills. For the rest of January, do nothing flashy. Build a watch list of real businesses and funds you understand. Write down the prices at which you'd be thrilled to own them. When February fear shows up, turn off the commentary, pull out your list. If the market offers you a castle at the price of a cottage, that's when you act. The January effect makes for good conversation. The January audit and February patience make for good long-term results. Don't chase the rally, prepare for the opportunity.